Welcome in, everyone. Hope everyone is doing well on this Thursday evening. This is the Real Estate Investing Channel. I'm Clayton Morris, longtime real estate investor, founder of Morris Invest. We're a full-service rental real estate company. And tonight on the show, we're going to wait till everyone joins us here. Sorry, we have some little craziness with the streaming software. YouTube loves to update their software randomly and wasn't running nicely with my normal streaming software. So that's how things go. But welcome in. Hope everyone can see me. You guys can see me okay. I just want to see if everyone can see me okay in the chat. You guys can hear me okay. Let me know if you guys can hear me okay in the chat window. Good afternoon. Craig Hansen says, so we're going to talk about the two ways to invest in real estate in 2021 that I think are the best, most advantageous. And we actually had some new news this afternoon, which even further solidifies my position on that. So we'll get to that. Everyone in the chat can see me. Wonderful. Good to see Craig Hansen. Samantha Lee is here. Elvis Presley, longtime viewers. Good to see all of you who jumped over and are joining me. Good to see you, Janet. Hello from Florida. Evelyn, Ethan, nice to see you. We're going to talk real estate. I'm going to take some of your questions here. Feel free, if you'd like to leave me a voice question, you can. We're going to take calls tonight. You can do that by going to our website, morrisinvest.com/Clayton. Again, that's morrisinvest.com/Clayton. You are in the Real Estate Investing Channel. This is the channel where we help to make you a more intelligent real estate investor. It is the backbone of my investing journey over the years, is investing in real estate. To me, is a tangible asset. It's something you can hold on to, touch, see, feel, fix up, build from the ground up, and the tax advantages are second to none among all of the asset classes. You know, if you're trading stocks, of course, you're paying term capital gains taxes. So you're not creating passive income. Yes, people certainly can argue on the dividend front. That's true, but on the dividend front, you're dealing with a smaller asset class that you're able to use, and even there, you're paying those capital gains taxes in a way that you're not having to pay with real estate investing if you understand how to do it properly. Plus, it's the lowest amount of taxes you can pay among asset classes, I believe, and one of the best ways to build wealth. So good to see everyone tonight. Hello, everyone. Alfonso Steele is here. Toff Goff is here. Judy Poole. Nice to see you, Judy. Hey, from Georgia. Don Nemi is here. Hello from the Chicago suburbs. You guys are freezing up there, aren't you, right now? Are you guys getting hit with more snow? Yeah, hit that like button. So we only focus on real estate investing on this channel, and we're hyper-focused on that. So we will take your questions tonight. Tonight, where we're going to talk about the two best ways to invest in real estate in 2021. Don Nemi says it's snowing a little bit now, and Samantha Lee down there in Texas. I hope you have heat, Samantha. Do you have heat? Hey, you could do like Ted Cruz and just fly to Cancun. Okay, we're going to wait till everyone gets in here. Give another minute or so. Like YouTube likes to send out notifications later than they should. Okay. Luis Mendez. Good to see you. Snowing in Livingston, New Jersey. Hey, I used to live right near there. I used to live in Florham Park. Jim Scandola in Houston, good to see you. Melody Archer says, hopefully your kids don't scare you. No, they're in bed. No, they're not. They're running around here somewhere. You're in Ohio? You got a little tiny plug-in heater, so at least you have electricity down there in Texas. Okay, that's good. Jeez, I'm sorry to hear that. Really? You've seen me walking in the Florham Park fields. How funny. Theo B asks, can you write off solar payments made on a solar lease in a rental house? Can you write off solar payments made on a solar lease on a rental house? I just bought a house that came with a solar PPA lease, and I pay it with no reimbursement from tenants. Every state is different, and I don't know. I would definitely talk to your accountant on that. I don't know who you're using for an accountant. They better understand that stuff. If your CPA does not understand that, if your tax advisor does not understand that, you need to find a new tax advisor that understands real estate. We have a lower your taxes tab on our website. If you go to morrisinvest.com/lower taxes, the team that we work with is with Wealthability. So go through our website because we have a special relationship with them. Well, they will do like a free phone consultation to see if you're a fit. So maybe you should just talk to them and find that question out. They'll probably be able to get you an answer on that. Some leases, yes, you can carry them on and they pass down, but some don't. And that's a problem with people getting solar panels, is that it only goes to the current owner. And then if you sell the house, then that person doesn't get the benefit of it. So you need to be careful. And it depends on the particular type of lease you have. We're actually in the process of doing solar ourselves. It depends on if you buy it outright, you pay for the panels yourself, or if you're leasing it and you've got a lease situation. So there's multiple ways. I think there's like 3 or 4 different ways you can do it now. So please check with a CPA on that. Sal. Nicole says, I'm over the snow. Sal, so I'm thinking of leveraging my paid properties and getting some money out of these. Course would be under an LLC. What are your thoughts on it? So I'm thinking about leveraging my paid properties and getting some money out of these. Course would be under an LLC. What are your thoughts on it? Yeah, for sure. Look, anytime you can get money out, like I always say, you cannot eat equity. So if you're sitting on equity and you have the ability to leverage those properties, that's how smart rich investors do it. I will go back to a friend of mine who now owns thousands of properties. I don't own anywhere near that many properties, but a friend of mine in the New Jersey area bought his first property. He fixed it up. It was a duplex. I think he bought it for $80, fixed it up, and then ended up, he held it. He's keeping that property. And then he was able to refinance it because now the value was up over 220. So he was able to pull that equity out, and he bought his next one, bought his next one, bought his next one. Now he's over 2,000 doors that he owns. So yes, being able to pull that money out is a smart way to do it. If you can get a home equity line, I would check with Churchill Mortgage. They can do those. And I would also look at Flagstar Bank. They do some good refinances, very affordable. Next life. Is Morris Invest losing into building down near Austin? Gigafactory providing a lot of jobs in the area. No, we're not investing. We don't invest in Austin area, but we're in other parts of other parts of Texas, which are really really high growth areas. Just that area to us is really overinflated from a pricing perspective, so not in our cup of tea. Not in our cup of tea. All right, everyone, welcome in. So if you're new here, go ahead and smash that like button, subscribe to the channel. This channel is totally devoted to real estate investing. So, all right, let's get to it, shall we? Here's our show tonight. Welcome into the Real Estate Investing Show. Tonight on the show, we are going to be talking about 2 ways to invest in real estate in 2021 that I think take the cake. And we just got some news this afternoon on some different rates and so forth that really solidify for me my position on these 2 ways of investing in real estate. So if you're new here, go ahead and smash that like button and please subscribe to the channel. We only focus on real estate investing on this channel, hyper-focused on that. And we aim to make you a more intelligent real estate investor. So I get asked all the time, should I pull out Should I pull out money of my home? Should I use cash to invest in real estate? Should I get a hard money loan? Should I, take a home equity line of credit out on the property that I currently live in to buy real estate? All good questions and all legitimate ways of investing in real estate. But tonight I want to talk about two specific ways that I think in 2021 are proving to be a really solid place and a solid play for you to be investing in real estate with. Forgive the preposition at the end of a sentence here. It's been a long day. So let's talk about strategy number one to invest in real estate. A funny story for me. Back when I started real estate investing, I was a big proponent of, at the time, it was both me being a proponent of it, and it was also because of the market situation. You really had to kind of come to the table with cash. You had to come to the table to be able to pick up some of these foreclosures and short sales and other things. You were not getting a mortgage. You had to be able to jump on this and be able to get cash. And banks were not lending. Banks, of course, after the 2008-2009 collapse, were saying, hey, we're pulling back, especially on investment properties, because of the hot water that we saw ourselves in at the time. But of course, that collapse and the reasons that was such a problem were for people that were taking out loans that didn't have jobs, ninja loans, no income, no job. And they were buying real estate and they would live in it for a short amount of time and they just walk away from the mortgage. Oh, I don't have a job. I can't pay it. Foreclosure. And banks were taking on all of these properties, taking them back. So when you were trying to find investment properties in 2010 or 2009, 2011, 2012, you might have found a lot of foreclosures. You might have found properties that needed a lot of work. They've been sitting vacant for a while. They've been broken into. That was the type of property that I was investing in back then. Some of these smaller single-family homes that needed some work. They had maybe 50-year-old home, brick homes, smaller. But I had to swoop in there. I had to pay cash, my own money, from some resource to be able to pick up this property at a great deal because investors would be picking these things up quick. So you could not get a mortgage. No bank was going to give you a mortgage on a fixer-upper. It was not going to happen. And especially if you had bad credit or something else, no way. It's not going to happen. So lending really dried up. So for me at the time, that was really how I was picking up properties. I saw the value in, not having that debt, not having that leverage, not having that leveraged property with a bank. But things have changed a lot. So the types of properties that I now invest in, particularly, are new construction. Those are the properties that have my most attention. They're the ones that I can add the most value to and demand the highest rent for as well, and be in great school districts in expanding neighborhoods with high jobs, low crime, low vacancy, low taxes, in really amazing expanding markets with a diversity of employment. And the way that I really believe, especially in 2021, given these interest rates, to invest in real estate, the first way is through conventional financing. So looking at the rates today, I just pulled those up here just a few minutes ago. So the interest rates of this afternoon are on a 30-year fixed, and I follow these every day, and they never move. I mean, they move by like a tenth of a point. Right now, a 30-year fixed mortgage, 2.9%. And that's even up a little bit. That's a 3-month high right now. That's a 3-month high over some fears in the market about the Federal Reserve and trying to contain inflation. But let's talk about inflation. We hear this being thrown around quite a bit, and yet Federal Reserve Chief Jerome Powell and new Treasury Secretary Janet Yellen have been focused on making sure that interest rates, that inflation rates stay around that 2% mark. Now, they are going to run hot over the next year. We heard that earlier this year from Fed Chief Jerome Powell, that inflation rates would go a little hot, maybe 2.5% or so for a little while, but that's not happening yet. And these interest rates are almost a full point down below where they were a year ago at 3.9%. So at 2.9% on a 30-year fixed rate, are you kidding me? Well below the inflation rate, and it's other people's money. So let me, like where I used to be in putting out my own cash for properties, my goal and the thing that we do at Morris Invest, our company, is that we want to make sure that when a client calls us and gets on the phone with one of our team members, one of our people will say, like, we want you to try to keep as much of your own money in your pocket. with over 60 different lenders that we're working with, all competing for your business right now, and the housing market as hot and solid as it is, we have an affordable housing crisis in this country. We don't have enough homes. We need to build 20 million homes in the United States, and we are nowhere close. Heck, at our company and our team, we're building around 300 this year in 2021. 300 homes. And we need 20 million? We're nowhere close to fulfilling that need. So there is incredible demand. Why do you think we were allowed to build during the lockdown? Because builders were deemed essential workers to continue building during this housing crisis. So with interest rates as low as they are, the demand for housing, the demand for rental housing and affordable housing in great school districts, it's a no-brainer to use the bank's money since they're willing to lend it on these great assets. And at 2.9% on a 30-year fixed, heck, let's look at a 15-year. Jump down to 2.3% this morning. 2.3% on a 15-year fixed mortgage. Now, why would we do that? Well, number one, it keeps more of your own cash in your pocket, okay? So you hold on to more of your money, and I hope that you're putting it in some smarter investments, right? You're putting some of it into a self-directed IRA that you can hold other assets, but you're not keeping it as a US dollar. You're moving that money more intelligently, maybe putting it in some gold assets or something else that, is moderately liquid, maybe even looking at crypto, but keeping it away from the US dollar. But having those interest rates, which are, at that price, you're basically getting free money. Why are you getting free money? At that interest rate, it's virtually free. So you're able to pick up an investment property, a $250,000, duplex that's brand new construction built from the ground up with granite countertops and vaulted ceilings and an amazing tenant in the property that's cash flowing, and you get to do it on the backs of a bank. And you're putting down a 20, 25% or 30% or so down payment on that property. So let me just give you some rough numbers. I mean, like at our company, like a down payment on one of our properties is going to be around the $35,000 range to work with us. And then the bank carries the rest. Now, every month you've got two tenants or one tenant, depending on if it's a single family or duplex, cash flowing, paying you rent every month. They have a great place to live. It's paying down your mortgage, so you're increasing your equity position. And it's going back to the bank. And the beauty is then, of course, that equity is being built up. That equity is being built up. Not only are you saving money on your taxes, you're getting the tax benefits of owning real estate. Then, of course, you're getting the benefit of equity increasing. And you're a hedge against inflation. Because remember, $1 in the bank today is worth less tomorrow. But $1 in real estate, which is appreciating higher than the rate of inflation. So all of these things to remember when you're investing in real estate. Not to mention the fact that, if you've got a great CPA, you're going to be paying lower and lower taxes because now you are in a different league as an investor, earning passive income. Especially if you're an active real estate investor, you become a different. You qualify for different tax advantages, of course, as an active real estate investor. As a real estate professional. So Luis, one of our viewers tonight, said he's working to get his real estate license. Great. So if that's your primary job as a realtor and you're investing in real estate, now you're a real estate professional. And now you're in a completely different tax bracket because you're an active real estate investor. So anyway, conventional financing right now, and I don't see any change in this coming through like 2023, 2024. And even if these rates go up to 3%, heck, I have rental properties that I had with mortgages upwards of 5.8%. Again, if your return on investment is a 11, 12% cash on cash return, money coming in from tenants is an 11 or 12% cash on cash return, and you're paying 3% to a bank, winner, winner, chicken dinner, right? And you're building up that equity and your nest egg. And then you can begin to roll that equity into other properties. So conventional financing, using other people's money right now, like if you book a call with our team at Morris Invest, like we work with 60 different lenders. You'll jump on the phone with us for 30 minutes. Just go to morrisinvest.com and we'll walk you through the process. One of our team members will. And we have lots of different options. But so that is why I think that conventional financing is one of the strongest options for 2021. I don't see any change. And news of this afternoon is that traders are expecting interest rates to rise over 1% by the end of 2024. 1%? That puts us back to where we were last year. And then, of course, mortgage rates, if you have the main interest rate from the Federal Reserve, the benchmark interest rate by which all things are based, then mortgage rates can, yes, decide to move in certain directions or not, depending on what the mood of the market dictates. But 1% by the year 2024? Now is the time. Now is the time to take advantage of this free money. There's no reason you should be using your own cash. Yes, for the down payment, but beyond that, use other people's money. Use the bank's conventional financing options right now. It is the best gig in town right now. The second way that I think to invest in real estate right now, the second best way in 2021 to invest in real estate is with your self-directed retirement account. Now, I'm not talking about your 401k. I'm not talking about your IRA. I'm talking about a truly self-directed IRA. Now, here on the channel, we've got a bunch of videos. You need to watch our whole series on self-direction. Okay, we've got a great team. That's our specialty. So our team at Morris Invest will get on the phone with you and walk you through that entire process. But a self-directed IRA, we can even set it up for you in about 10 minutes. So if you've got some old IRA that's just floating around out there and you're not touching, or unfortunately you've lost your job and you have a 401k that's sitting there from an old job that you haven't touched or done anything with, roll that into a self-directed account, in which case now you truly control it, okay? You truly control it. I'm not talking like a Fidelity account. I'm talking about a truly self-directed account, which now you can buy assets inside of. So you can buy real estate inside of that self-directed account. Like this afternoon, I've got one self-directed account that I have that has about $40,000 in it. What I'm going to use that for is as a down payment on a rental property and conventionally finance the rest of it. So now I will buy a rental property inside of my self-directed IRA, okay? And I'm going to have conventional financing from a bank funding the rest of the purchase. Brilliant, right? So you can patchwork these things together. You can both use conventional financing and a self-directed account. So that money is just sitting there not doing anything. Now it's going to start earning like a 12% cash-on-cash return, because now all of the rental income is going to go in to that self-directed retirement account, and it's going to grow tax-free. That's the brilliance of a self-directed retirement account, is that it will grow tax-free. So all of that rent that's coming into it is going, when I retire, I won't have to pay taxes on it. Now, there's a lot of things to understand about the self-directed. I'm not going to go into all of them here. Our team, and we have a whole series of videos that walks you through what you can put into a self-directed account and how exactly it works. You've got to watch our great interview with Haley from our team. She's our self-direction expert on our team. So she walks through all of the questions and answers on like what you can do with a self-directed account. Please check that. We'll actually, when this video is done, we'll make sure we have a card up here you can click on to watch that full video so you have a deeper understanding of self-direction. But it's a very, very powerful tool. And the beauty of self-direction is that it gives you an advantage over the other markets right now. Self-direction, of course, has multiple ways in which you are protected. It's a hedge against inflation. Of course, it's growing with tax-free. What's amazing about the self-direction account that I don't think a lot of people understand is that it gives you the flexibility and you get total control over it yourself. A lot of people think they have an IRA and they're like, oh, but yeah, I have a self-directed account. I can just call up Fidelity and I can invest in, Ford or General Motors stock. No. That's not a self-directed account. A truly self-directed account gives you the power, and you work with a custodian and at very little fees per year. With those other brokerage accounts, you're paying tons of money in fees that most people don't even realize. So again, self-direction, and the power of conventional financing. And heck, when you combine the two of them, fantastic. So please check out those options. And if you are ready to invest today and you want a team to help you take care of all of it, just go to morrisinvest.com, book a 30-minute call with our team, and we will walk you through those those options. And if we can't help you, we'll point you in the right direction. We do this all day long, so our team is ready to help you. We'll have a link in the description below for that. I want to open it up for some great questions now. We also have some phone calls here that I want to play. So let's listen into, I think we got some phone calls here. Let's hear from Craig. Your question. Go ahead, Craig.
Sir, I was wondering, how do you attract your Section 8 tenants? That's what I'm wanting to do. I'm wanting to get Section 8 tenants, but I just need to know how to attract them. So I love your advice on that, how you attract your Section 8 tenants for your rentals. All right, thank you so much, and have a blessed day.
Thank you, Craig, for the question on Section 8. Of course, Section 8 is, it differs from state to state and locality to locality. I like Section 8. I don't have a problem with Section 8 at all. The only downside of Section 8 tenants is the process, that it usually takes about 3 months for you to receive your first rent check because of the processing time. Now, you'll receive that first rent check and it'll be it'll have 3 months worth of rent in that first batch that you receive. Your property has to qualify for Section 8. So number one, you've got to make sure that with the county, you're qualified as Section 8. But most counties will actually have a website or a portal. I know, as I spoke about my friend in New Jersey, he loves Section 8. That's one of the ways that he makes money. That's one of the ways that his main driver of rentals is Section 8 tenanting. So what he does is there's a portal. He will basically advertise his property on the Section 8 portal right on the website. And it's for Section 8 tenants to apply. So it's a very, very simple process. Every state is different though, so I'm not sure where you're calling from, Craig, but that's a way to do it, is to check with your localities. How do you get your properties in front of a Section 8 property? For instance, on another part of New Jersey, there was a Section 8 representative, and we just contacted her. And she had a waiting list of Section 8 tenants that were looking for properties, 4-bedroom, 3-bedroom, 2-bedroom. And if it checks a box, she'll be out there the next day, potentially with a tenant looking at the property. So, very interesting. I like Section 8 because they have to pay a certain amount of their own money, but then of course the government is taking care of the rest. And in crazy times, Section 8 can be powerful and it can be a good hedge against craziness. But some people are not a fan. I have no problem with it. And I've done videos in the past on Section 8. Let's take a look at some of our other questions coming in here in the chat. Let's see. Next Life wants to know, what's the typical price and rent for a new construction duplex with us? Next Life. It depends. We have a range on prices. So again, I would just book a call with us and we can walk you through some of the different properties. We have single families that are in the low 100 ranges, and we have some duplexes that are in the mid 100 ranges, and then on up into the 300,000 range. And they vary. We have some of the lower cost properties that might not have like granite countertops and those types of things, but then they're near student housing, near like Texas Tech University, et cetera, that have like 3 bedrooms, 3 baths. So it's great for student housing. Very durable, and tenants that you never have a loss of tenants in those properties. And the same thing is true of our higher end stuff. Tenants that stay 5-6 years and longer. Like I'll give you an example. There's a subdivision of duplexes that we built about 6 years ago now. The same tenants are in the property today. They moved in when they were brand new and they're still there. I was recently in one of our markets in Lubbock, and we went through one of those units that was built about 6 years ago. It was in the process. That one was particularly in the process of a tenant turnover, and it looked brand new. Like it looked like it was just built. So again, that one higher end, granite countertops, stainless steel appliances, vaulted ceiling, and that can rent for upwards of $1,300 per side of a duplex. $1,300 to $1,500. So looking at about $3,000 a month in cash flow from a unit like that. So again, range in prices from like maybe $800 in rent on one side of a duplex on the lower cost side on up. But again, book a call with us and we'll walk you through that. Don Nemi says, thanks for the information on Section 8. I just saw a building for sale and they talked about Section 8 that are renters. Yes, just make sure you have the paperwork. So if someone's advertising a building that's for sale, I'm always a little leery, Don, of like, what's the word? Adopting? No, not adopting. Why can't I think of the word tonight? Adopting someone else's tenants. Like if you're going to buy a property where the person advertises that it's already like, hey, it's like a tired landlord situation where he's 75 years old and he's owned this property for many, many years and he's telling you he just wants to sell it and he's got great tenants in the property and they're all Section 8 and here's our price and so forth. Inherited tenants, that's what the word I'm thinking of. I'm always a little leery of it because first of all, I want to see rent rolls. I want to see proof that these tenants are current with their rent. I want to see proof of Section 8 documentation. I would even call the Section 8 office to confirm. Like there's a lot of things I would check on with those situations. So Janet, yes, we do. We're constantly, Janet wants to know, do we build in other states besides Texas? Yes, we do. Tennessee and other states. We're constantly analyzing markets. And it has to meet really 10 of our major criteria for markets before we even think, and it will take over a year analyzing markets before we move into a market. Preston on our field team, who's fantastic and who really goes out and analyzes all of the field work on our properties and where we're going to be building, spent like almost a year in one market not too long ago. And I mean, he was constantly, flying back and forth and at the end of the day, there was like 8 out of 10 things that he liked, 2 of which he just, it just wasn't enough. And it wasn't up to the standard. And we just stopped. We didn't move into that market. So there's a lot, there's a lot that we look for. We look for vacancy rates. We want to make sure vacancy rates are low. We want to make sure crime is low. We want to make sure that jobs are increasing. We want to make sure that population is increasing, not decreasing. We want to make sure that we can have access to great property management. We want to make sure that it's recession proof. So the areas that we're building in Texas are really, as CNBC has pointed out, have been like recession proof markets. They're not affected by swings of like tourism and other things. They've got Fortune 500 companies that are moving there, multiple diversified job industries, not just one. Like there's not just one super Walmart in town where everyone works. What happens if that super Walmart goes out of business? You're screwed. All those tenants leave, they're screwed. Or one oil refinery? No. So we have healthcare and universities and hospitals and other Fortune 500 companies. So those are things we all look for. Don, yes, please do your due diligence on that. I mean, you really want to see rent receipts, rent roll, et cetera, if you're thinking of pulling the trigger on that. Let's see. Sherry Mitchell says, I don't even want to come out of pocket for the down payment. Well, there are some, like if you don't want to come out of the pocket for down payment, there's some options too that you can do, which is like if you go to our website at morrisinvest.com, we've got a funding tab at the top where you can get 0% interest funding, which you could even use as a down payment and have the conventional financing for the rest. So that's an option. Again, go to our website and check that out. TT says, what if the tenant decides not to renew the lease? Wouldn't you be stuck paying the monthly mortgage on that property? Yes. But that's why you want to have great property management. You want to be, like for instance, at our company, if we have a tenant that leaves, we've got such a great team in place that we can have we have a waiting list for tenants in the property, a waiting list. Because these tenants, first of all, we have a housing crisis in the United States and people need housing. And we're in markets where there's great school districts, jobs. So the tenants that are on that waiting list are like, oh, that person's leaving, let me in. And then it'll take about 2 weeks, the crew to get in there, clean up, just do a wholesale cleaning of the property, maybe touch up paint, that sort of thing, do a tenant turnover and get a new tenant in that property. That's why you have to have a great team. You cannot do this yourself. If you do this yourself, you're on a road to ruin. I know some people have success being a self-made landlord, But that's a full-time job. If you run multiple properties and you are managing your properties, that's a job. Do you want phone calls in the middle of the night from tenants? No, that's why you have a great property management team that handles that. Jim Scandola says, when buying a property as SDIRA, do you not have to go non-recourse, which requires 40% down? Yes. Well, so what Jim's asking about is, and I don't want to go too deep into non-recourse financing. If anyone's curious, I have multiple videos on non-recourse financing. And again, talk with our team about self-direction. There's been some loosening of these things recently, given COVID relief or the CARES Act and others. But non-recourse financing, you're going to have to put between, it depends on your credit score, basically, and it depends on a couple of other factors between, in the bank, 35, 40, maybe 45% down with a self-directed IRA. So financing with a self-directed IRA where you're buying that inside of your self-directed IRA, and then you've got a bank carrying the rest of that for your investment. And what non-recourse financing means, it's that they are backing the asset itself. They are not backing you, the investor. They've looked at the property. They walked through the construction phases of the property. They've seen the tenant go into the property. They know the town very well, and they are putting their name on that property asset, and they're giving you money as non-recourse with no recourse for the purchase of that property inside of your self-directed IRA. So non-recourse with a self-directed IRA is a fantastic way to go. Let's see here. Let's see another quick question. Thank you, Sherry Mitchell. Says, I enjoy your shows. Thank you so much. Kevin Krause says, wanted to buy a duplex to live in and rent half, but need 20% in Wisconsin, so I bought a house. I would still like to get into rentals, but don't have the savings. Any advice besides saving up 20%? I would still like to get into rentals. Yeah, again, check out our funding tab on our website. That's certainly an option for you. That's a way that I've used to bring in about $190,000 in 0% interest that you'd get for about 12 to 18 months. And then you can actually extend it beyond that at 0% interest. So again, go to morrisinvest.com/funding to look at that option. Let's see. TT says, I have one investment property and one mortgage, and I don't want to take on more than I can handle. That's right. Vince says, what is a downside to using a self-directed IRA for purchasing rental property? I understand you can't utilize depreciation in this case. Correct. So you don't get the tax benefits by owning it inside the self-directed, but you get the tax benefits of it being tax-free wealth. So you're not paying taxes on the cash flow that you're earning. So if you need, one of the downsides of buying a property inside of a self-directed account is like, if you need that monthly cash flow every month to live on, then maybe not the best option for you because you can't touch that money until you retire, right? You want to let that money grow so that when you retire, you've got this incredible nest egg now, tax-free. So think of it like any other investment. Maybe you own a few properties outside of your self-directed IRA, and maybe you own a few of them inside of your self-directed IRA. And the ones that you own outside of your self-directed IRA, you can use that monthly cash flow any way you'd like. Inside the self-directed IRA, you don't touch it. And therefore, it's less liquid. I mean, real estate in and of itself is not a very liquid asset, right? If you need to sell it, it's going to take houses are selling like crazy right now, right? Everyone wants real estate. So, Warren Buffett said if he could buy up every single family house in America, he would. So it's not liquid. It's not like it's a stock where you can sell it like that, and get access to those funds pretty quickly. So that's one downside. But then also you get all of the tax benefits from rental real estate. So, I mean, on the self-directed side, that's really the only downside. The illiquid nature of it and the fact that you don't get the tax benefits of depreciation, but you're getting a whole host of other tax benefits of buying it inside of a self-directed IRA. Here's another question. Let's listen into Craig. Or no, so Mario. Mario has a question. Let's listen.
Hello, Clayton, and thank you guys very much for all your education. We listen to you guys all the time, and it's really helped us a lot. My name is Mario, and my question, my girlfriend and I, we are here in Southern California. We bought a couple of houses separately because we're not married yet. We started a LLC, a business, and we do ADU and garage conversions because of the new laws in 2020. You can look us up online, by the way. We're strategic-conversions.com. At any rate, we're not married yet, but we are going to get married. And I'm wondering, is that going to affect us, our buying power? In other words, if we were separate versus getting married. I don't know where you guys were when you started, but I just thought that would be a good question, and it would really help us. Thank you very much for your answer. Bye-bye.
Hey, thanks, Mario. So, if you're buying them in an LLC, it shouldn't matter because the business is buying them. It just depends on how you're structuring that. Now, like with non-recourse financing, it wouldn't matter. So, like if you work, like I don't know if you're going to continue to buy in California, but let's say you worked with us and you bought a full service turnkey duplex non-recourse financing in an LLC. That's one of the other benefits of non-recourse. It's not going to matter. Your buying power, you and your wife. But now if you're coming together jointly and you're debating whether or not to put one or the other's name on the particular purchase agreement and then therefore the deed, and you're getting conventional financing, yes, of course, conventional financing sadly is of course tied to your credit score. So that's something to consider. And if one of you has a high debt to income ratio, I know when my wife and I got started investing, we didn't know better than to put it in an LLC. We got started years ago. So we were buying them in our own names. And when we were doing it that way, I think like one of us had a high debt to income ratio. I don't remember. I think it was actually my wife had a high, I don't know what it was, but anyway, then we put him in just my name. And then like the next one we put in her name. So we kind of bounced back and forth depending on our credit worthiness, I guess. And it's kind of ridiculous. And then you're sort of opening yourself up to more liability by putting them in your own name. So if you can buy them in an LLC, and here's the thing, you don't have to buy them in an LLC right away. You don't have to set up an LLC when you're investing in real estate right away. You can go through the conventional financing way, and you can take care of that LLC process later. But it did affect it with the conventional financing. It just depends on your debt to income ratio and credit score. Of course, the United States of America is both it's a good and a bad, right? It's a debt society. We operate on debt in the United States, and therefore our credit score is, it's heavily weighted. It's very important. Where in other countries it's not so important. I hope that helps answer the question. But, if you're doing it through business, if you're doing it in an LLC, if you're buying it with like non-recourse financing, then it shouldn't matter. I would certainly shop around and see if that's available to you rather than doing the conventional route if you're going to do that. But financing, using other people's money is still the name of the game. Let's see any other questions here on this. Marlon Barrera says, hi, Clayton, a question. How much will be on the end every month after expenses buying a property with a 50% down? So I would say it depends on the property. So if you're putting $35,000 down and you're carrying a 30-year or 15-year mortgage or smaller, 10-year, whatever, on $300,000 new construction duplex that's cash flowing $3,000 a month, it's going to just depend on the rate, how much you put down, and what is the overall cost of the property. And then after that, so if the mortgage comes in at $1,200 and you're cash flowing $3,000 a month, then of course you've got that additional $1,800 that's cash flow positive for you. You're going to want to set aside money for expenses and repairs, but it's new construction, so you're not going to have expenses and you're not going to have repairs for many years to worry about. They're brand new water heaters, everything brand new, and tenants that tend to stay a very, very long time. So I would put that money towards other investments, or put it in your savings, or put it into a self-directed account and keep that money growing for you. And then if, in 7 years you have to change a water heater for $700, $800, $1,000, then you do that. And you can pull that out of that. So I would say it really depends on the size of the property and the cash flow. If it's a single family or duplex, there's all variables to take into account. But if you've got a mortgage for $1,000, $1,200, $1,100 a month, and it's cash flowing $1,500 a side of each side of the duplex, then you're bringing in $3,000 a month. So some things to think about. Tristan Miller says, what about buying to get better rates and quit claiming it to an LLC? Yeah, these are all things that our team can handle for you. We can talk about those things on the phone. We've done that multiple times. And as Garrett Sutton writes about, the great real estate lawyer, Garrett Sutton, a friend of ours from Corporate Direct, he wrote a great book called The Loopholes of Real Estate. He's a lawyer. And absolutely, you can buy a property like that and transfer it over, and you should have no problems. Let's see. Gary Meyer says, I can't find a lender that will lend to a non-owner occupied nor a multifamily investment owned by an LLC. I can't find any of these sub 3% with a 20 plus year fixed rate, something you can help with. Gary, yeah, that's what we do all day long. On all of our properties we're building this year, like when you work with us, when you close on the property, the tenant is already in place and the financing is already assigned to the property. Like we already have financing ready to go on the properties that we're building. New construction completed with tenants already living in the property that just wrapped up construction. And I think Nicole is in our chat right now, one of our team members. Nicole, do you know what does our latest inventory look like? They're the conventional, are they duplexes? I think they're the new construction or the townhomes that we just wrapped up. Well, Nicole answers that question. Let's listen to another call here. This one is from Jackie. All right, Jackie, thank you for your phone call.
Hi, Clayton. We have a property that we purchased for cash, and what we'd like to do is leverage the property to purchase another property. However, we're having a hard time finding a lender and or a bank that will give us a loan on this property that's held in an LLC and that we own free and clear with no mortgage on it currently. Thanks so much.
Isn't that funny? That's ridiculous, isn't it? That's ridiculous. Banks are competing like crazy right now to try to get money into the marketplace. The liquidity, Federal Reserve is pouring trillions to make sure that banks are lending so that some bank, give me a break. It's ridiculous. I'm sorry, Jackie, that you're having to deal with that. Give Flagstar Bank a call. They're national. I've done multiple refinances with them, with properties being in an LLC. They do a fantastic job. So I've done multiple refinances and loans with them. Also, I would check out Dan Kraus at Churchill Mortgage. We'll put that in the show notes. I think if Kelly can put that in our show notes for today's episode, we'll put that there as well. He does a great job. And we'll also make sure we have some other resources below. That's surprising to me. It's ridiculous. The house is paid off, right? And I guess it's cash flowing too, right? And you've taken the extra step of protecting yourself. It's in an LLC. What you might have to do, it's not a big deal. We've had to do this before, which is just transfer it back to your own name to do the loan. And then right as soon as you're done, transfer it back. We've done that a couple of times as well. So not a big deal. Don't let that get in your way. Hopefully that helps. And try those two banks. Hopefully they'll be of assistance to you. I know they've helped a lot of our clients over the years do that exact same thing. So, lending stuff switches a lot, and we're obviously in a pandemic, so things could be different, but you shouldn't have an issue. I'm hoping you won't. So thank you for those questions. Again, if you'd like to leave us a voicemail question, to ask a question, go to morrisinvest.com/Clayton. And you can ask me a question. We'll answer it here on our show. We also have our podcast, of course. We release this as an audio podcast. You can find us on iTunes, just called the Investing in Real Estate podcast. TT wants to know if we build duplexes. Yes, we do. It's one of our specialties. Thank you, Nicole, for answering that. Nicole says, okay, our up-and-coming inventory will be approved for our conventional financing program. So we have multiple And we are then going to have inventory approved for the self-direction program coming next. So conventional financing program is first up, and we will have our self-direction program as well. So we have multiple programs. We also do portfolio programs where you can buy multiple. We have clients that come to us and need to buy 10 properties at one time. So we have portfolio program as well that we can provide. And if you have friends that you want to team up with, maybe you don't have a full down payment on a property and you'd like to team up with a couple of your friends, form an LLC. You each put up $10,000 as a down payment, and you own with conventional financing a rental property together. So we have that as well. So we have multiple avenues that we can help you if you're interested. Amani says, I'm wanting to start a real estate LLC with my son, but I do not want to mess up his interest rate as a first-time home buyer. What can he do with his interest rate as a first-time home buyer? I don't think that wouldn't affect it because it's not if it's for an investment, it shouldn't matter. The first-time home buyer program is for primary residence. Like you have to live in the property under your own name. Hope that makes sense. You cannot live, you can, but you really, when you live in your own property, you buy it in your own name. Now, Garrett Sutton talks about the benefit of then, once you own it, you can transfer it to an LLC later on, but let's not get into the weeds here. The first-time homebuyer program, and I think it's changing, and I think under the CARES Act, there's some new things that we may actually see here in the next week or so with the new stimulus bill that should be passed late next week or the weekend with those $1,400 stimulus checks. But there's also a provision in there, as I was going through the 500-page bill, that for first-time homebuyer incentives, an increase to the first-time homebuyer credit of $15,000. So that shouldn't affect it because you have to be a primary resident of that property. But again, I'm not a financial advisor or an attorney, so check with your CPA on that, okay? Check with your CPA to find out for sure what the newest law is. And then next week, when that changes under the stimulus, things are going to change there as well. Ryan says, how do I invest if I have bad credit and no money? Well, Ryan, there are three ways to start getting started real estate investing. Okay, a lot of my friends who started with nothing were in your situation. Okay, so if you have nothing, there are three things you need to invest in real estate or to buy real estate. Number one, you need money. Number two, you need people. And number three, you need a deal. Okay, so if you have no money, then you need to find people and a deal. Now, what you can do is you might go out and hunt and get hungry and find an awesome deal. Well, guess what happens when you have a great deal? People and money come to you. You attract it. Investors want great deals, and investors don't have time to find great deal. So what I would encourage you to do is check out some of our videos here on the channel on wholesaling, figuring out ways where you can get like $50,000, $60,000 a month in cash from like doing driving for dollars and wholesaling and bringing in some extra capital. Another thing you can do is use our funding tab on our website and book a call with the team at Fund and Grow, and you'll get $500 off your sign-up fee if you end up working with them. They will help fix your credit, and you'd also be able to get 0% interest funding with them. But that's probably not the best route for you. I would consider really trying to go out and like learn how to do wholesaling, start from the ground up, start to find deals, put your feelers out to bigger money investors. And if you can find deals, they'll pay you finder's fees. They'll pay you $10,000, $15,000 for the property you found. They'll do all the work on it, but now you just got a $10,000, $15,000 payday for finding them a deal. So there's multiple ways to do that. That's awesome, Janet. Thank you, Amani. I really appreciate that. That's very kind of you. Ronald Lee, that's so sweet of you. Jose Carlos Fernandez says, hi, Clayton. I'm from Chicago. I have a little balance on my first property, a single-family home, and I'd like to know how to transfer it to an LLC and start getting financing to invest in real estate out of the equity. Well, before you jump on moving it into an LLC, I would contact, you're in Chicago, I would contact Flagstar Bank. Okay. Because it's still in your name, contact them to do a refinance, to pull out equity. Then once that's complete, then you simply get on the phone with a lawyer, and for like $150, you can transfer the ownership of that property to an LLC. Have them do it properly, okay? And then it's in an LLC. Now you have the equity and refinance the home equity line of credit, or however you want to do it. So that's what I would consider doing. Again, if that doesn't work, I'd also consider, again, Churchill Mortgage. My friend Dan Kraus, he's been great, and he's a good friend. Tell him I sent you. He's a great guy. So check that out. Oh, that's a great point. So Nicole says, Ryan, you can also, Ryan, one of the things you can do is we have an ambassador program at Morris Invest. So even if you don't buy a property, you can refer people to us who do buy a property, and then you get money towards the purchase of your property. We give you a credit every time you refer somebody. So it's possible that you could literally buy a house with no money. You could get a house for free by referring people to us. And by the way, every time they then purchase. So we have almost every buyer we have is a repeat buyer. So like once or twice a year, they will add another property to their portfolio. And so every time they do that, Ryan, you would get credit for that. So go to our website and check that out. It's morrisinvest.com/refer if you want to get, if you want to learn about that. So anytime you buy a property, and if you personally buy a property with us, you can refer your family, and then you'll get credit towards your purchase of the house, which is awesome. So my thanks to everyone for joining us tonight as we talked about the 2 ways to invest in real estate. And thanks to all of our callers tonight who called in with some great questions. You can leave a voicemail if you'd like. Go to morrisinvest.com/Clayton. I hope you learned a lot tonight. It was great watching and interacting with everyone tonight. Harry Kamal, let's see. One more question. Harry, is it better to invest in multiple states or in one state of investing in multiple properties? Look, there are certain states that are very landlord friendly and some of the best states in the country to invest in. Unless you own thousands of properties in one particular market, you're not really like, I love some people are like, should I diversify? I own one property in Texas. Should I now think about Arkansas or Tennessee? It's like, okay, you've got one property. Remember, if you own a single family house and you own a single family house next to each other, that's diversified because that tenant is totally different than this tenant. That tenant has a totally different job than this tenant, probably. So in many ways, that's diversification. I wouldn't worry about it when you're talking 1 or 2 properties. When you're talking hundreds of properties, that's when you can start to think about having some in different areas, but I wouldn't worry about that yet. Don't put the cart before the horse. Hope that makes sense. Thank you, everyone. I really appreciate it. Thanks for joining us tonight. If I brought you any value at all, please go ahead and smash that like button and share this video with any of your family and friends. We'll have links to everything we talked about in the show notes. If you're interested in giving us a call, our team will take care of it. Get on the phone for 30 minutes with you. And so just go to morrisinvest.com. That's the website. We'll have a link in the show notes again. So go there and check it out and book a call with us. We'd be happy to walk you through our process, talk over some properties, new construction duplexes that we've got, and other single families that are coming online very soon. And excited to work with you guys. Much love to all of you. We will see you next time.